Good morning and welcome to the Killik market update. So you may have noticed this week that US equity markets took out all-time highs. The S&P got there on Monday and the Dow Jones on Tuesday. And I thought it might be an opportunity to have a quick look at the chart and see where equity markets have performed year to date. So just taking a quick look at the chart, we can see here that global equity indices remain firmly in positive territory year to date. Maybe a little point of note there is a turquoise line, which is the Japanese stock market, where there's been a bit of trade tension between themselves and the South Koreans. But on balance, broad market drivers remain firmly in place this week, which is most notably US rate cuts. We've also moved into US earnings season for Q2. We've seen the likes of JP Morgan, Citigroup, Goldman Sachs, Abbott Labs, Johnson & Johnson report better than expected numbers. I suppose one company that we've probably seen in the press that hasn't fared quite so well is Netflix. They actually fell 11% after their update. So the reason for the loss was primarily concern surrounding the user growth numbers for the company. So actually this quarter marks the first quarter that Netflix has ever lost users in its domestic US market. I think of more concern generally was the slowdown in international user growth numbers. So the company itself guided towards about 4.8 million of net new users was the expectation, and they delivered about 2.8 million. So it's a fairly decent miss on that front. I think one of the things that analysts are probably concerned about at the moment is the timing of the slowdown, potentially, and probably particularly given the onset of the coming launch of Disney's rival platform, Disney+. I just wanted to mention trade wars and US interest rates very briefly. So the expectation for US interest rate cuts has been adding some buoyancy to markets over the last few weeks, and it does look like the case for those cuts now is firmly cemented on renewed trade tensions between the Chinese and the US. No meaningful progress has been made since the G20 by way of face-to-face or via phone. So the Chinese demands to come back to the table and discuss meaningfully trade terms remain unmet until such time. It doesn't look like we're going anywhere particularly soon. So it seems pretty inevitable then that we'll see a trade war related US interest rate cut on the 31st of July. The trade tensions have certainly done gold no harm over the last few weeks. It's continued its run higher. Now, there are a number of reasons that gold has continued to run and breaking out a little bit to the upside of late. But one of the primary reasons is that of momentum. So when we talk about momentum, we talk about more and more people becoming involved in the story, buying the breakout, for example. We can see this in the price of gold miners. We can also see this, the shares of gold miners, I guess, and also in terms of the ETF flows into gold-based products. So if we take a look at the chart here, we can see that gold is now up just over 12% on a year-to-date basis. But notably as well, silver is starting to play a little bit of a catch-up here, which is having fallen by the wayside over the last few weeks, but closing some of that gap. So I guess an important point to note as well is that central banks have been active buyers of gold, but probably most notably China actually over recent weeks and months, maybe looking for a different place to park money outside of US treasuries given the US trade wars. Finally, just wanted to mention very quickly about the UK. Parliament made further moves yesterday to block a forced no-deal Brexit scenario in October. And of course, we have the results of the Conservative leadership contest due on Tuesday. So the FX market's been fairly efficient in pricing in a Boris Johnson victory, but nevertheless, we could see some pickup in sterling-related volatility over the coming weeks and months, regardless of who finds himself in number 10 on Wednesday morning. Looking ahead to next week, fairly busy earning calendar with Q2 earnings season in the US, but we'll be looking out for Amazon, Thermo Fisher, and Alphabet in particular. That's all from us this week. Have a great week, and we'll see you next time.